Hello friends, in this video, today we will talk about how to build a stock portfolio with very small savings. So in this video, I will focus on those retail investors who have very small savings, and from those small savings, how they can build a stock portfolio on their own. Remember, when I'm saying building a stock portfolio, I'm essentially talking about building a stock portfolio with a very long-term horizon. When I say long-term horizon, I mean 10, 15 years. It will take that much time to build a stock portfolio on which you can depend on. A stock portfolio which will actually give you financial independence. How to build a stock portfolio from small savings. And when I say small savings, I mean 3,500 rupees in a month. Suppose you have that income that you cannot save more than 3,500 rupees that you can invest in the stock market. You have that limitation. Is it still possible to build a stock portfolio from such low savings? It is possible, and in this video I will share what is the method you can use to build a stock portfolio using small savings. I have been building my own stock portfolio since 2008. At that time, I was in early 30s. So I have some experience with stock portfolio building, and I will share my experience of building the stock portfolio. I will not talk about general rules or general stuff. You will find direct actionable points that you can use to build your own stock portfolio. But before we go ahead and start discussing about the actual steps related to stock portfolio building, I want to talk about a very essential point. What is the minimum amount you should invest in stocks at a time? Let's assume that you are using traditional stockbroker who charges you a brokerage, security transaction taxes, and other taxes and duties. If you will add all these overhead costs related to your stock trading, you will find that around 0.7% is your extra cost. Suppose you are buying stocks worth 100 rupees, then the actual cost that you will pay to buy that stock will be 100.71 rupees. So considering this overhead cost of 0.71%, the minimum amount that you should invest at a time while buying a stock should be 6,500 rupees or more. So suppose you are somebody who can save only 3,500 rupees a month. In this case, what you should do? You should not invest every month. For 2 months, build your savings. In 2 months, you will have 7,000 rupees, and then every 2 months you should invest in the stock. So this is the limit. Now let's start with the actual steps that you can use to build your stock portfolio. The number one step is creation of a watch list. Why watch list is necessary? Watch list is your reference point. If you want to buy a stock, you have to buy the stock from your created watch list. So it is very essential to create a reliable watch list. And suppose you are somebody who has not invested in stock till now. This is the first time you are going to invest in a stock. So what you should do? From where you will get this reliable stock list? You will get it from the indices like Sensex, Nifty 50, Nifty Next 50, Mid Cap 100, Small Cap 100, Small Cap 250 stocks. These are the names of all the indices. If you will add all the stocks of these indices into your watch list, you will approximately have around 300-350 stocks in your watch list. It will be too much. I think for a beginner who is just starting to create his own stock portfolio, he should not have such a long watch list. Instead, you should start with Nifty 50 as your reference. Open an Excel sheet or a Google sheet and note down the list of all the Nifty 50 stocks. There will be 50 number stocks in the Nifty 50 basket. So note down all those 50 stocks, the name of all those stocks in a Google sheet. This is step number one. In the next step, you will learn how to shortlist these stocks. You cannot buy all the 50 stocks. You will buy one stock. And how to shortlist that one stock? For a long-term investor, the rule of stock investing is buy a quality stock at an undervalued price. Not every time you get a chance to pick stocks which are actually undervalued. And especially if we are talking about a Nifty 50 basket of stock, they generally don't trade at values lower than their intrinsic value. So what we should do? The next best alternative for us, pick those stocks which has already corrected a lot. Because these are quality stocks. They may correct today, but tomorrow, because their fundamentals are strong, they will again go up. I am basically a contrarian investor. Contrarian investor is that type of investor who buys those stocks which other people are not buying. It is best for a contrarian investor to buy that quality stocks with other people are selling. So if other people are selling or other people are not buying a stock, its price will start to fall. And buying a falling stock which has a very strong fundamental is our strategy. So now I will discuss 3 shortlisting steps that you can use to identify that one stock from your list of 50 watch list stocks. Step number 1, find out of your 50 list of stocks, which stock has corrected the most in last 1 month and in the last 3 months. So in your Google sheet, you have made a list of 50 stocks. Go to Google search and type the name of the stock with a phrase share price attached to it. If your stock is, let's say, is TCS, then search for TCS share price in Google search. Google will give you a price chart of TCS. In that price chart, you have to check how much the price has moved in the last 1 month and in the last 3 months. If you want a ready-made answer for this, you can even use my stock engine. You have a list of 50 stocks, and for each stock, you have to note what has been the price movement in the last 1 month and in last 3 months. Out of these 50 stocks, now you have to find 5 such stocks whose negative price movement has been maximum. Note these 5 stocks separately in your note. The next step will be for these 5 shortlisted stocks, you have to note how much dividend the stock is yielding at present. Again, you will find this data in the Google search itself. Note down the dividend yield of all these stocks. Mark those 3 stocks whose dividend yield is maximum. Now we have to execute one more step. You also note down their P multiple. You will see you will have a list of 5 stocks for which what information you know, their 1 month price trend, their 3 month price trend, dividend yield, and their P ratio. Among these list of stocks, you have to find one stock which has corrected the maximum, whose dividend yield is also reasonable, and whose price to earning ratio is lower than other stocks. So you have to find one stock, and that one stock will be your stock which you are going to buy now. So this is a very simple method of shortlisting stocks from your watch list. You have to go on repeating this step time after time. Every time you have funds available for investing, you have to follow this method of shortlisting your stocks. As you gain experience, you can increase the number of stocks in your watch list. But remember, the longer will be your watch list, the difficult it will be to gather the data, this price trend data, the dividend yield data, the price to earning ratio data. It will start becoming more difficult for you if your watch list becomes too long. Within a year, you will have around 7-8 stocks in your portfolio. In 2 years time, you will have around 15 to 20 stocks in your portfolio. By the time you reach this milestone of 20 stocks in your portfolio, you will have to hit a pause button. Why this pause button? Because it is essential not to add too many stocks in your portfolio. Why it is important? Because adding stocks more than 20 in my stock portfolio makes it difficult for me to review that portfolio. One small method that I use to review my portfolio is to read the related news. I go on reading news, maybe small, maybe big. Whatever news is there related to my stock, I keep on reading. And this is the practice that you should also develop. If you have, let's say, 50 stocks in your portfolio, imagine how difficult it will be for you to read the related news of all those 50 stocks. So that's why this limit of 20 stocks should be maintained. Every time you add a stock, record the transaction. What data must be recorded? On which date you have bought, the name of the stock, the quantity you have bought, and the total cost that you have paid to buy the stock. Stock portfolio building is not only about buying and selling stocks. You have to do something more. In the next step, we will discuss that. But in order to take those steps, you must have a ready list of your transaction data. Here, I will also like to mention one thing. Let's understand it with an example. Suppose you have bought Reliance Industries, let's say in 2020, and in year 2021 you found that you are getting another opportunity to buy Reliance Industries. So you see, once you have bought Reliance Industries in 2020, you have again got an opportunity to buy in 2021. Similarly, you may also get opportunities in the coming years. So record all these transactions. A single stock you may be buying on multiple occasions. In one of the steps, I will talk about portfolio rebalancing. But to do portfolio rebalancing, we need three data of each and every stock that you have bought. One data is CAGR of each stock holding, the average holding time of each stock, and the weight of each stock in your portfolio. Suppose the total value of your portfolio is 1 lakh rupees, and out of this 1 lakh, 5,000 is of Reliance Industries. So in this case, the weight of Reliance Industries will be 5%. The second is the CAGR. Now you remember I talked about the example of Reliance Industries. On different dates, you have invested different amounts to accumulate Reliance Industries. For this kind of transaction, how you will calculate the annualized returns? In Excel or in Google Sheets, you can use the XIRR function to calculate the CAGR returns. In this video, I will not go on explaining how to calculate the XIRR, but in the description, I will leave a link of one of my blog posts. You can visit that blog post, and there it will clearly show you how to calculate the XIRR or CAGR of your investments. So we have discussed about the weight, we have discussed about the CAGR, and the third point is the average holding time. Let me explain you the concept of average holding time using an example. Suppose you bought Reliance stocks worth 10,000 rupees in 2020. Now in 2025, you again bought Reliance Industries stocks, but this time you invested 50,000 rupees. Now if I will ask you, what is your holding time for Reliance Industries, how you will calculate? To find the holding time, you will have to use the concept which is called weighted average holding time. Again, I will not explain you how to calculate the weighted average holding time. In the description, I have left a link to one of my blog posts. By visiting that link, you will understand how to calculate the average holding time of your stock. For each and every stock that you have included in your stock portfolio, you have these three data: the weight of the stock, average holding time, and you have the CAGR. With this data, for all the, let's say you have 20 stocks in your portfolio, for all those 20 stocks, you have these three data set. Now using this three data set, we will take the next step of doing the portfolio rebalancing. What is portfolio rebalancing? Portfolio rebalancing is basically a method where you sell some of your stock, and the money that you generate by selling, you reinvest it to buy another stock. But there must be a rule that you must follow. You cannot book profit in any stock. So what is that rule? This rule consists of 3 points. The CAGR of that individual stock must be more than 30%. So does it mean that a stock which is giving me a 30% CAGR, I will sell that stock? No, I will not. There is another criteria. The next criteria is the weight of the stock in the portfolio. The weight of the stock in my portfolio should not be more than 5%. Why 5%? Suppose you have 20 stocks in your portfolio. So 100 divided by the number of stocks. If the number of stock is 20, then the weight should be 5%. If any stock whose CAGR is more than 30% and whose weight has gone beyond 5%, such stock becomes a candidate for portfolio rebalance. But I will add one more step here. The next step will be the average holding time. If a stock shows an average holding time of more than 3 years, only then I will do portfolio rebalancing. So there are three rules. First is CAGR more than 30%. Second is the weight should be more than 5%. And the third is the average holding time should be more than 3 years. If a stock satisfied all these three criteria, then that stock becomes eligible for portfolio rebalancing. What does it mean? It means I will sell a part of my holdings. Let's say I have 100 numbers of Reliance Industries. I will not go ahead and sell all those 100 stocks. I will sell only that quantity that will bring the weight below 5%. Let's say if I sell 10 number stocks of Reliance Industries, it weight will come down from, let's say, 5.5 to 4%. So this is good enough. I will not sell all my holdings. So this is how you should practice portfolio rebalancing. And once you have applied portfolio rebalancing, you have sold some stock, you will get some money. It is very, very important to reinvest this money back into the portfolio. Generally, what I do, suppose I have Reliance Industries in my portfolio. Whenever I sell Reliance Industries, if I have applied portfolio rebalancing to Reliance Industries, and let's say I have generated, let's say, 25,000 rupees after rebalancing, I generally wait for Reliance Industries stock to correct. And let's say the stock has corrected by, let's say, 7-8%, 10% or so. When I see such a correction in my holding stock, I will use the money that I've generated from rebalancing and I will buy more of Reliance Industries. I told you the shortlisting method that we use, one of the parameter in that shortlisting stock is high dividend yield. So most of the stock that I hold, let's say 70-75% of all my stock holdings pay me some dividends. In building a successful stock portfolio, it is very important to reinvest this dividend. Dividend reinvesting is a very important point in building a winning stock portfolio. Suppose you have a stock called Embassy REIT. Why I'm taking this example of Embassy REIT? Because this is one of those stocks which pays maximum dividends. I think at this current price of let's say around 430 rupees, the dividend yield of this stock is already 5%. Let's say Embassy REIT is currently trading at around 433 rupees per share. In the last 4 quarters, Embassy REIT has paid you, let's say, around 5,000 rupees worth of dividends. What is your investment threshold? Remember, you will invest a minimum of 6,500 rupees in a stock. So this is your threshold, and Embassy REIT has already given you 5,000 rupees as dividends. So what you will do, let's assume that you are adding 2,500 rupees more from your pocket. So what is the total capital now available for investing? 5,000 rupees from dividend plus 2,500 rupees from your savings. So you have 7,500 rupees. Using a capital of 7,500 rupees, you can buy approximately 17 shares of Embassy REIT. How you will record this transaction? How much you have paid to buy 17 stocks? 7,500 rupees. But in your transaction recording, you will not say that you have spent 7,500 rupees for buying 17 stocks. You will say only 2,500. Why it is so? Because 5,000 rupees is like a free gift. Dividend is a free gift. But that 5,000 rupees has enabled you to buy 17 stocks by adding 2,500 rupees more from your savings. So what you will do, you will, in your transaction, you will say that on this date, I have bought 17 numbers Embassy REIT stocks by paying 2,500 rupees, not 7,500. I know someone of you might be wondering that why we are using this creative accounting. See, we are investing in stocks, we are not investing in a fixed deposit. We are investing in stock. Why we are investing in equity? Because in long term, we want to benefit from the power of compounding. How to benefit from the power of compounding? There are 2 ways. First is you have to hold your stocks for a long term, and you will also have to take steps to enhance the return on investment, which is CAGR. And dividend reinvesting is one method to enhance your CAGR. How? Suppose there are 2 people. One person buys 17 numbers of REITs paying 7,500 rupees. Another person has paid 17 numbers of REITs paying only 2,500 rupees. Whose CAGR will be higher? The second person's CAGR will be higher. How the second person has paid only 2,500 rupees? Because 5,000 rupees, Embassy REIT, the company itself has given you 5,000 rupees to buy more of its stocks. Think of it like this. So this is not actually creative accounting. This is a motivation for you to reinvest your dividend. And why you are reinvesting your dividend? Why you are feeling motivated? Because it will enhance the CAGR of your complete stock portfolio. Every penny that you received as dividend, you should reinvest. You are treating your dividends as a free money, and you're not spending that free money. You are using that free money to buy more of your stocks. I hope you liked this video related to how to build a stock portfolio from very little savings. It is not a shortcut method. It takes years to build stock portfolio like this. Even small income people can use to build a large stock portfolio of their own. It will take time, but this is, you can say, a kind of a sure shot method which will take you to financial independence. I hope you like this video. If you like it, do subscribe to my YouTube channel